You wake up, you check oil prices, they're jumping. And suddenly the United States is moving aircraft carriers like it's rearranging furniture. What is happening? Is this diplomacy? Or is this the world saying, all right, round two? The US has just warned Iran to make a deal. At the same time, it's stepping up military deployments in the Middle East. Now when a country says let's negotiate and also sends fighter jets, that's not casual conversation, that's pressure. Let's break this down. America has reportedly increased naval presence, missile defense systems, and rapid response forces in the region. That's not symbolic, that's positioning. And markets noticed. Because whenever the Middle East gets tense, oil traders start sweating faster than a student before results day. Here's why oil matters. Almost 20% of global oil passes through the Strait of Hormuz. It's one of the most important choke points in the world. If tensions escalate and supply gets disrupted, oil prices spike. And when oil spikes, transport becomes expensive. Food becomes expensive. Flights become expensive. Your Zomato order becomes emotionally painful. Now imagine oil jumping 10 to 20%. Inflation, which central banks are already fighting like it's the final boss level, suddenly gets stronger. Higher oil, higher inflation, central banks keep rates high, growth slows. That's how geopolitics enters your wallet. Now let's talk Iran. Iran says it's ready to defend itself. Naval drills continue, rhetoric increases. But here's the twist. Nuclear talks are still happening indirectly. So we're in this weird situation where diplomats are talking calmly in rooms, while warships are parking aggressively outside. It's like negotiating peace while loading the cannon. So what are the possible outcomes? Scenario 1, deal happens. Sanctions ease. Iran exports more oil. Oil supply increases. Prices stabilize. Markets relax. Scenario 2, talks fail. Tensions rise. Even without war, just the fear of disruption can spike oil. Markets panic first. Facts come later. Now let's zoom out. Why does this matter globally? Because oil isn't just fuel, it's an input into everything. From plastics, to fertilizer, to transport, to manufacturing. Oil shocks historically trigger recessions. 1973, oil shock. 2008, energy spike contributed to pressure. Every time oil moves violently, economies wobble. Investors respond fast. Gold usually rises. The US dollar strengthens as a safe haven. Emerging markets struggle because they import energy. And stock markets? They hate uncertainty more than they hate bad news. Bad news is predictable. War risk is not. Now here's the strategic layer. Is this real war preparation? Or is this negotiation leverage? Sometimes military buildup is meant to prevent war, not start it. But history shows something dangerous. When tension rises and forces increase, the risk of miscalculation rises too. And wars don't always begin because someone wanted them. Sometimes they begin because someone misread a signal. So what should you watch? Oil prices, shipping activity in the Strait of Hormuz, US defense statements, Iran's naval movements, and most importantly, inflation expectations. Because if oil surges again, central banks could delay rate cuts, and that affects home loans, business expansion, stock valuations, currency markets. This isn't just about missiles, it's about money. And in global economics, wars don't just destroy cities, they reset markets. EconMatrix, where economics meets reality.